Hi, welcome to another sequence of IDFC's Money Wisdom. I'm Rolf Dobelli, author of The Art of Thinking Clearly, which explains thinking errors. And I'm here to talk about a big one, the sunk cost fallacy. Let's start with a story. My wife and I bought movie tickets online for $30. The tickets were non-refundable. On the way to the theater, we noticed a beautiful sunset. I said to my wife, "Sweetheart, do you really want to go to the movies now? How about we just skip the movies and park by the beach to watch this gorgeous sunset? It's unique, it's spectacular." And she said, "Well, I'd love to do that too, but let's go to the movies so we haven't just spent $30 on nothing." And I answered, "Sweetheart, this is a classic thinking error." Well, maybe that wasn't the nicest thing for me to say, but it really was a thinking error. And that thinking error is called the sunk cost fallacy. Sunk costs are costs that you can't recover. And these costs can be money or time. The point is, sunk costs should not play a role in your decisions. But unfortunately, they frequently do, and that leads to costly, even disastrous, errors of judgment. Going back to our movie example, we already had spent $30. That was non-refundable. The $30 were sunk costs. So the wise choice would have been to disregard the sunk costs, to just leave them out of the equation and focus on the question, what would give us the most happiness, the movie or the sunset? And we both agreed it was the sunset. Investors frequently fall victim to the sunk cost fallacy. Often they base their selling decisions on acquisition prices. Here's a typical example. You buy a mutual fund or a stock or any other security and the price starts to drop. Should you sell it or keep it? You tell yourself, "I've lost so much money with this stock, I can't sell it now." That's irrational. This is the sunk cost fallacy in action. How much money you've already lost on that stock should have no bearing on whether you should sell it or keep it. In other words, the acquisition price, the price you paid for it, should play no role. The only thing you should consider is the stock's future performance. From today on, will it make money for you or not? Ironically, the more money a stock loses, the more investors tend to stick with it, which is a mistake. Now that you understand the dangers of the sunk cost fallacy, how can you apply that knowledge to your investment decisions? Number one, know that the sunk cost fallacy exists and causes errors of judgment. Beware of it. Number two, don't look back at the price you paid for your mutual fund or your stock. Whether you paid a high price or a low price must not influence your decision to sell it, keep it, or buy more of it. Whether today's market price is above or below your original purchase price is completely irrelevant. See every day as a fresh day. Number three, if you spend a large amount of time researching an investment, that time is also a sunk cost. Thus, it should not influence your decisions about buying the investment or not. To sum up, the sunk cost fallacy is a severe and frequent trap in life, in business, and particularly in investing. It's in your past. Don't let it hurt your future. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
To watch more videos about making wiser money decisions, click one of these links here.